And my advice would be if you are planning to generate wealth by investing, definitely buy investment property or properties first, and then focus on your principal place of residence. That will be my advice, because I think I see the next year is that the biggest opportunity to buy property, because the markets will be shaken.
100%.
It will be great buying. So um,
GFC, best opportunity. Then it was the APRA changes. Then it was COVID. And what happened after every single one of those, those huge economic impacts? And the fundamental thing is that we've got a housing shortage. If we had a million homes where we had only 200,000 to find for, happy days. Wait, because property won't go up, but it will because we've got a housing shortage. It's supply and demand. G'day everyone, this is Einke here. Welcome to Investor Journeys, where we chat with everyday Aussies and seasoned investors about their property journeys, the wins, the stuff-ups and everything in between. Whether they've got one property or a whole portfolio, we dive into how they did it, what they've learned and what their journey's been like so far. No fluff, just real stories from real people. So let's get stuck in. G'day everyone, welcome back to the IJ podcast. It's been a little while, but we've got a little bit of a different episode for you today. Obviously, there's been some big changes in the federal budget recently, and a lot of people are thinking, okay, what does that mean for myself? And obviously, there's a lot of media articles out there about what's happening with the property market, right or wrong. But one thing that is always true is what actually happens to finance. So we've actually got a very fantastic guest with us today, someone that I've been working with personally a lot with our clients as well. And she's actually been on an earlier episode to talk about her journey as well. So you can track back on that one. But welcome, Jasmine, from Prosperity Mortgage Broking. Thank you for joining us today.
thanks, Iga. It's so great to be with you again. It's fantastic.
Yeah, absolutely. And look, we pretty much talk on a daily basis, but today it's for the guests, and really want to unpack what the latest changes mean for the buyers out there. Now, obviously, we're going to be taking a bit of a investor lens to this whole budget, and predominantly it's affected the investors anyway from a property perspective anyway. So, we want to cover a range of topics. So, Jasmine, do you want to just give us a recap of the changes that got announced? Now it's probably now a couple of months ago, or a month ago. But yeah, do you want to give us a quick recap?
Yeah, the famous 12th of May.
Yeah.
I remember, it's ingrained in my memory, because I was texting with a lot of investors clients and they were saying, "Oh, I'm glued to the TV. Can't wait to hear the announcement." But it is a great place to start, because a lot of people have seen the headlines, but they don't necessarily understand what actually has been proposed. And the first thing that I will say, that there isn't just one change in this famous budget, but majority of people are actually talking about negative gearing.
Yep.
But in fact, there are three major proposed reforms that all investors need to understand, and they kind of all interact with each other. So I'll just first start with the most famous one that the media is talking about, like, on a daily basis, literally. And that's the negative gearing. All right. The easiest way to think about negative gearing is that if your investment property costs you more to own, then it's bringing in. So, for an example, let's say your investment property generates $30,000 per year in rent, but your actual expenses, such as the interest that you pay on the mortgage, or the rates, the insurance, the land tax now, and any other maintenance, add up to, let's say, $40,000, you effectively lost $10,000 by holding that property. And in the current rules, that loss technically reduces your taxable income. So if you're earning $100,000 a year, the ATO will assess you as though you've earned $90,000 instead. And this is where the tax benefit comes in this sort of shape or form. Now, since the announcements, the government has said they will grandfather all properties purchased prior to 12th of May, 7:30 p.m. Um, Anything else purchased post that date and that time will be treated differently, and that pretty much scrap negative gearing. Okay, so they said no more benefit of such for future investors, with only one exception, and that exception is if you purchase a brand new property. So you will still be able to negatively gear your losses if you buy a brand new property. Okay. Now, I just want to also clarify this common misunderstanding that I find every time when I speak with clients that are first time investors. Many people misunderstand negative gearing. Um, and many people kind of think that negative gearing with negative gearing you're kind of making money. It doesn't mean that. You're still losing money on your property. It's just that the tax benefit that you were getting just slightly softened the blow. So if your property was costing you $10,000 to hold, for an example, after these tax benefit, you typically would reduce the real cost to something like four, five, six, or $7,000, depending on your personal circumstances. If you hold one property, for investors that hold more property than that, then obviously that figure increases. And historically, that's why investors use negative gearing, not because they enjoyed losing money, because they were willing to wear that what we call short-term cash flow loss, if they believe that the property will grow significantly in value over the next 10 or 20 years. Now, the proposed change means that from 1st of July 2027, investors who will buy an established property, they'll no longer be able to do this. And what will happen in the future is that those losses will become quarantined, and they can only be used against either future rental profits or future capital gains from the property.
Yeah, I think that's an important point because a lot of people think, look, it's completely gone. It's actually an offset, isn't it? And so what we find statistically is that the point about negative gearing is that properties tend to become start negative geared, as you mentioned, because the rents are at its lowest, and as rents increase, it becomes positively geared over the course of generally 5 to 10 years. And the irony is that you're probably on a higher income at that point, and so you're probably going to be offsetting more with the negative, with the losses that you've made. But obviously the way the media are pointing it out, and I suppose the way people think is that, oh, okay, it's completely gone. And a lot of people don't have that long-term view, in my opinion, in terms of using those losses in the future when it becomes positively geared. I've got properties that are positively geared. I would love to negatively gear some of my positively geared properties in terms of offsetting the gains that I'm getting now, but I can't. So that's something that investors need to know.
Absolutely. And it only happens in the first years of ownership of the property when you become an investor, and ultimately every property, after a certain period of time become positively geared. So it's just a period of time. And if that drives you to to purchase an investment property, probably you should rethink the strategy. There are different things that you need to be focused on when you're buying an investment, and certainly negative gearing or shouldn't have been, your primary focus. Most definitely. Anyway, also, a lot of people were buying properties as investors in trusts, and negative gearing is not possible in the trust structure. So, yeah, and it works quite similarly. You could carry your losses. So, yeah, that was the first change from the budget announcement. The next one was CGT, so capital gains tax. So currently, if you hold a property for more than 12 months and sell it for profit, you will generally receive a 50% CGT discount. So as an example, if you sell it with a $200,000 profit, you only pay tax on $100,000. Now, what the government has said is that this, or the proposal that needs to be voted in Parliament, is that it will be replaced with inflation adjusted method and introduces a minimum of 30% tax on future gains. So this sort of change causes a lot of discussion. I can just hear in different social media reels from accountants and tax planners saying or asking additional questions, because this will be something that will be quite complex going forward for accountants. This comes into force from 1st of July as well, 2027. So yeah, it will be interesting place to see. And I've already seen accountants that are recommending that people do valuations on their investment properties, because the old model will be applied until 1st of July 2027, and then subsequently the new CGT tax will be applied. So
Yeah, I've heard. Yeah, it's a hybrid sort of situation for those who have owned properties before, and I've heard that property values will be the most popular industry in 2027 because of all the valuations that need to happen. So yeah,
we might see May 2027 that might not be available.
correct.
So yeah, it will be interesting to see how that evolves and how it impacts people. But accountants are definitely, in a way, already complaining about, the volume of work that they'll have to go through in order to calculate the CGT. Definitely changes the complexity behind it.
And what was your first thoughts when you heard these changes, Jasmine? Because you've got a property portfolio of your own, and you've got a mortgage broking business. What were your first thoughts when you heard it?
Yeah, look, for me, even before the changes were announced, I mean, we for 2 or 3 months there were speculations that things will change. Yeah, people were saying negative gearing will be scrapped. We just didn't know the extent of it. We didn't know whether existing properties will be grandfathered. We just didn't know. I know how lenders are viewing or how they are calculating borrowing capacity. And I was saying even to my clients, we are doing these projections that you can buy 2 or 3 properties in the next year or two. However, if any of the negative gearing changes that are speculated do take place, scrap the planning that we've done so far. Nothing will be the same, because, yeah, as I said, banks are using that tax benefit that negative gearing was giving. So that credit of 5, 6, 10, 15, or $20,000 that people that own multiple properties and or higher incomes were using in the servicing calculation, that would not be available going forward. Therefore, it will present a very different borrowing capacity and what people can do in the future. So yeah. One important distinction that I want to make: these changes only apply to residential property, so they're not applicable to commercial properties. You can still negatively, if you buy a commercial property in your own personal name, you can still negatively gear it. So that's something that people need to be also aware of. Yeah.
Well, I think commercial property has been a very popular asset class since the budget because of those reasons, not just for the negative gearing conversations, but also from um, uh, basically these changes aren't affecting those. So yeah, I think from a positive cash flow and not having these impacts has a lot of investors looking at commercial. So I think from your perspective, the big question is, how did these changes impact borrowing capacity from your perspective, Jasmine? You've touched on the lenders used to take into account negative gearing. How has it been impacted now?
Okay, so there've been significant changes literally a couple of days since the announcement, since the budget announcement. Macquarie Bank was the first bank to come out and say we'll be changing the way we calculate borrowing capacity. They are actually leaders in the market for many things, and they were the leaders of the market for this as well. And I think that's guided also by the NCCP Act, which is legislation that protects consumers. So they had to think, okay, how will this actually impact borrowers, and will be irresponsible for us to treat these to ignore these changes. And even though it hasn't been voted in Parliament, the banks started implementing the changes, and one by one, especially the majors. So ANZ has moved, NAB has moved, CBA has moved, they've updated their calculators, and what they've done is that now they've stopped using the negative gearing tax benefit in the calculation of borrowing capacity for any client that buys an existing property. So that's gone. So yeah, the calculations remain the same for anyone that wants to refinance their existing investment properties. That's nothing changes there. So people can be rest assured that if you want to move banks as an investor, that wouldn't be an issue at all. However, um, a person of the same salary, same deposit, same living expenses, buying the same property with same rental income, very different calculation. And we are seeing a difference between, sometimes it depends on circumstances. It could be $50,000 if you're lower income, that your borrowing capacity has dropped up to $150,000 for, a buying an investment property, pending again on many variables: purchase price, deposit, and income. So it
Yeah.
has changed. Yeah, and if you actually had a pre-approval a month ago from a lender, either go speak with your broker or whatever you got to obtain that pre-approval, because that's not going to be applicable for most of the lenders. There are some lenders who still have not implemented the sort of, or they have not removed the negative gearing benefits from their calculations. So you could potentially go with those lenders, but there was a second or third tier lenders, and of course interest rates are higher with those lenders, and they have different policies. Always they've had different policies for investors. So yeah, I'm not saying it's not possible to buy a property, an investment property, but definitely the rules have changed.
Well, I think that just showcases how important it is to talk to a broker, because beforehand, you obviously, you go to a broker to really understand the lay of the land with all the lending policies and out there. But now that you've got on top of this extra layer of lenders who are incorporating the negative gearing, those that are not, but there's other opportunity costs with going with them. There's just a myriad of so many different options that if you just go to one bank and talk to them to get your lending, you're probably more than likely 99% not looking at the right option. And so, because of the lenders out there. So I think that just shows you how important a broker is. And that, it's an interesting point you made about people having pre-approvals, because we had clients that we're working together with who had pre-approvals, and we were looking for properties for them. And then we had to go back and look at their situation and really analyze, okay, do we need to drop the budget? Do we need to look at different rental yields, which then affects the locations and all that kind of thing? So yeah, it's been really interesting, and obviously they're not going to get the negative gearing because they don't have a contract in place. So yeah, it's important to really talk to the professionals in the space about these changes for those reasons. So yeah, so you've touched on, I think you've touched on, a few of the lenders that have incorporated the negative gearing and that have not. Do you want to just quickly touch on the type of lenders that you're seeing at the moment?
Yeah, so all the majors have adopted the changes, meaning they've scrapped the negative gearing benefits. And the lenders that have not actually have announced that they will make certain changes, but they've said you've got till, for example, let's say, I don't know, it's mid of June to submit an application before we change the calculator. And then you've got the third layer of lenders, which are typically your lenders who are anywhere been different, like for an example, Brighton, they are still using negative gearing in their calculations, and you can still get an approval for buying an existing property. Yeah.
I suppose they can't be told, I suppose, or mandated not to use it because it's not legislated yet. So I suppose it's everyone is sort of free to choose what they want to do until it's legislated, I assume.
Yeah, 100%. But also what we typically, I don't know if you remember, but few years ago, I can't remember when was this, maybe 10 years ago already, when APRA brought in the changes that when you're servicing, when you calculating the borrowing capacity for anyone, you need to add the 3% buffer. Yes, that is legislated. A majority of the banks are using that 3%. However, there are still lenders, like, for an example, FirstMac, that instead of using 3%, they're just using 2% of a buffer. And many other lenders that are in this space that specialize in investment, they're using only 2% buffer. However, they have other levers that they use, such as, for an example, maybe they'll introduce a higher house expenditure measure. So your overall cost will be higher. So they have different policies. Obviously, they have done a calculation of how much risk they want to take in this space, but there are definitely sort of investor focused lenders. And you really, as a broker, need to know all of these policies and sort of place the clients where is most appropriate for their circumstances.
Well, yeah, I mean that's really interesting, and I'm just curious, like if they go against APRA's requirements, do they have to get approval, or can they? Is that just a guide? APRA's is just a guide.
Probably, yeah. I would say that APRA has made a recommendation, and majority of the big lenders that have decided to follow these recommendations because otherwise, the consequences could be dire, and they could be the negative PR, from not doing the right thing or was specifically the right thing, but the consumers might be, huge. But these smaller lenders, they definitely have different policies and different way of looking at things. And as I said, yes, they might, um, calculate the borrowing capacity at 2%, but their overall cost that they'll take for your day-to-day living, it's way higher than one of the major lenders. So there's a bit of a give and take, and I think they've found a way how to justify their approach, why they're using 2% and certain things, like maybe they take 100% of the investor income, and then they deduct a certain number for expenses, like a fixed number. So yeah, there are all these variations in banks' policies that as a broker, or particularly investment savvy broker, you need to be familiar with, and help clients to achieve their goals, in a manner that it's suitable for them.
I mean, yeah, I mean, the fact that, it's not a mandate, and the lenders can sort of use those recommendations but do what they want. It just means the brokers really need to be on the ball with all the different changes that they're making, because ultimately it's their call. It's their risk tolerance, the lenders' risk tolerances, which means, yeah, the brokers really need to understand what's going on in the space because there's so much competition. So, I would suspect in terms of the type of investors that are affected by these changes, are the type of investors that are pretty much originally was borderline in terms of getting borrowing, based on the income and expenses. And, you really had to go to the nth degree to find some sort of lender to able to lend for. It's those type of borrowers that I assume would be impacted by these changes. Is that what you're seeing at the moment as well?
Yeah, yeah. And look, to me, the way I see it, I mean, I see it on the grounds with my client. And unfortunately, as your regular mums and dads, investors, people, that are working in POG incomes, and probably the most significantly impacted group is the high income earners. Because, historically, they often receive the greatest tax benefit from negative gearing because they're paying tax at a higher marginal rate. But everyone's been impacted with this, and uh, anyone who actually planned to build a larger portfolio and relied on that strategy, negative gearing, to help them get there, has been impacted. The discretionary trust investors have also been impacted because, trust. I have a lot of clients that have bought investment properties not in their personal name but in a trust because of the flexibility, because there's asset protection, and also they can distribute the income the way they wanted. It's really good to estate planning. It also allows people to, in a trust, to have access to the CGT discounts. But now I'm seeing that many investors are actually starting to ask questions to their accountants, and tax planners, whether these advantages still justify the complexity and also the cost of maintaining these structures, because we all know trusts are expensive. Yeah.
Yeah, and look, the type of structures that have predominantly been exempt from a lot of these changes are the SMSFs and their own, principal places, right? So those two, and to my understanding, the companies as well. So do you are you sort of seeing any influence on how investors are structuring their property purchases from your perspective and experience, or is it too early to tell?
Yeah, no, look, I have seen, like in the last year, I've seen definitely an increase in SMSF inquiries. But I think since the budget announcement, and since the fact that all of these changes had virtually no impact on SMSF, so nothing is different about SMSF um, taxing, a lot of people have started thinking perhaps we should use it as a vehicle to purchase a property or properties. It's just that in the SMSF structure, you are limited to, the balance of your SMSF and the contribution. So it is, you know, you wouldn't be able to use it as what people are buying, 3, 4, 5, or 10 investment properties in their personal name. So it's a little bit restricted in that sense. But we did have definitely seen more interest in that SMSF space. Um, uh,
I think it's important. It's important for the listeners to understand though, when you buy an SMSF, it's not like you can get that money if you make a gain or extract equity. There's nothing like that, right? Like people think, oh, SMSF is just like a playing in the residential personal space or trust space. It's not. You can only access that money when you're 60 plus. So bear that in mind that it is a future retirement vehicle and it's a great tax effective vehicle. But the conversations we're having with clients is, yes, you can do that on the side, but it's not going to get you to your goals if you want to retire early, for example. So yeah, it's something to note. Yeah.
Yeah, no, 100% accurate. And it's probably a more efficient way of approaching or investing in property once you are, like late 40s or early 50s, and you're approaching, or, your retirement is coming close. But otherwise, for young people, like many rent investors, for an example, that um, went and bought number of investment properties prior to buying their principal place of residence, and use the tax benefits in their advantage. We see that now, unfortunately, that's not going to be available for young people, and I think that's a tax on aspiration, in my honest opinion. I think just that's terrible, absolutely terrible.
Absolutely. Obviously, I don't like to try and get too political on these podcasts, but yeah, for sure. It's if I didn't have negative gearing when I first started, it would have been a second thought for me. So it's a huge impact and an aspirational impact for sure. So and that's the word we're hearing all over. So absolutely. But look, the big question I'm getting, Jasmine, and not just from the changes, but I constantly have these conversations. Probably one of the most common questions I get as a buyer's agent is, Ainka, look, we're looking to upgrade our PPR, and but we're also thinking of investing as well. So I often say to them, it all depends on your emotional requirements in terms of upgrading, whether you want kids and you need to upgrade, you need a bigger place, and also the timeframes, because, investing is a long-term journey, and, buying your PPR in the short term can impact that whole investment journey as well. So uh, the big question I normally have is, how does the borrowing capacity get impacted by those who buy their PPR first? Let's say in a couple of years or in a year, within a year, um, how does that impact their future borrowing capacity to invest after that? Because just from my experience, I find that a lot of clients, when they buy their PPR, they don't really care about the price point as much. They go to the nth degree to get their dream home, right? They don't try and go half their borrowing capacity for this principal place, so they max it out. And
It's the dream, Anka. It's the dream,
yeah, it's a dream,
for
right?
most people, like,
Absolutely. It's part of their identity as well. So they go to the integrate. And my point is that with investing, you're trying to give yourself buffers in your investment journey, and you've got the lay of the land, as I say, to be within those parameters to be able to build a portfolios. Whereas PPRs, like I said, they go to their final dollar almost to get their PPR or even over. So when they do that, Jasmine, what does that do to their borrowing capacity? Because I would assume the banks would see the PPRs as a asset that doesn't provide an income, and so it would have a bigger impact than buying investments first, which do provide income, and then buying maybe a PPR later down the track once those investments have grown. So do you want to just quickly touch on that kind of topic?
yeah. You nailed it. I mean, you totally explained this perfectly, in a sense that the owner occupied property doesn't generate any income for you. So the higher your leverage, meaning if you've just got in and you bought that property with, let's just say, 5% deposit, and the property has been quite expensive. And if you live in Sydney, that's not going to be a surprise. Yeah.
Yeah.
That in essence will definitely limit your future borrowing capacity. And we've seen clients that have fallen into that position, and then it's hard to leverage and buy an investment property, particularly if the principal place of residence that you have bought have not grown in price. And I think we are in that sort of environment at the moment, that any property, particularly Melbourne and Sydney, I think it's any property that is over $1 million.
Well, that's everywhere now, isn't it? That's Brisbane, that's Perth, that's Adelaide.
Yeah, well, 100%. But if you are not generating equity in that principal place of residence, it will allow you to extract that equity and then go again and purchase an investment. It's also limiting. So if you do plan, my advice would be, if you are planning to generate wealth by investing, definitely buy investment property or properties first, and then focus on your principal place of residence. That will be my advice. And also, people that run businesses, if they are renting, they probably have tax advantages by renting somewhere else, but then purchasing investment properties. There are benefits to that if you're a business owner as well. So
Yeah, I think there's a massive opportunity cost because, a lot of people have those emotional goggles on with seeing their own PPR dream, and they don't want to rent, that they want that security, and that's all fine. Like, obviously go buy a waterfront house or whatever makes you happy, and obviously that caters to the family, and gives you that emotional security. But mathematically, it really impacts your future. And let me tell you, especially when you buy that dream PPR, in Sydney, Melbourne, wherever it is, and I always say to people, I can guarantee you're not going to downsize that in the next little while, because that's your dream. That's you've fulfilled that dream. And to live in a smaller place in 10 years just to retire early, people don't do that, and they would live in that forever, and therefore you've maxed out your borrowing capacity. What else are you going to rely on for a retirement if you're holding that property, paying off the debt over the next 30, 40 years? Huge opportunity costs. And I see it. I mean, I've got so many mates here in Sydney who are asset rich because they own their own family home, which, in my opinion, is a liability, to be honest. They own their family home, but they're having to work until 60, 65 because they know their kids can't go and buy another property in Sydney. And so they live at home, and so they have to keep, they can't downsize, so they have to keep living there. It's classic, right? So they're sitting on an absolute gold mine, but they're going to have to work until they're 60, 70, and that's their life gone. So anyway, I don't want to get on a tangent, but it's such a huge part of conversations that I have with investors. So, but we'll put a pause on that. I'll get back to the budget anyway. Are you seeing like a lot of investors hitting the brakes now in terms of the sort of the non-experienced investors, or those who obviously can't get borrowing capacity? Are you sort of seeing that at the moment? What are you seeing now with the budget announcements?
Is definitely a mixed picture. So some investors have paused, but interestingly and not unexpected, it's often those investors that are either first timers, and they were already uncertain even before the budget. The ones that were sitting on the fence, and kind of assessing, is it the right time? And then the budget and the announcement simply gave them another reason to wait.
Yeah.
Well, it's the reality, and I see it all. Yeah.
Absolutely. And the irony, Jasmine, is that these are the people who have the, let's say, the 600 to 800 budget, or it's in the affordable brackets, where they want to stay out of the game now because they've been influenced by this budget, and especially the media, and that they're the budgets that move the most during these times, because obviously those that had a bigger borrowing capacity now are playing in these sort of fields. Also, the yields are higher in these sort of affordable brackets, so investors are also in this space, and these tend to really converge into the medium tiers and the upper tiers of the price points, and they're just going to be priced out at the end of the day. Even when the borrowing capacity comes back, when rates come down and stuff. So I see it time and time again. I say, oh, I should have bought, when it was 500, 600K, but I was influenced by the media, and we see that all the time.
Exactly. And there's always noise. There's always something happening. See the interest
Always.
rates, or there's an election uncertainty, or there was COVID, or there's change to the lending rules. I mean, there's always something that will create headlines. But I think the investors, what I have found from experience is that the investors who build wealth, they just tend to focus on adapting, pivoting, and doing what's needed to achieve their goals, so they're not
Yeah.
waiting for perfect
Long
conditions.
term. It's long term.
That's it. Yeah.
Yeah, yeah, absolutely. It's just concentrate and focus on the numbers, and couldn't agree more. And I think the advice to new investors is really cut out the noise, isn't it? And focus on that long term, and really, understand how these budget changes have affected finance, because ultimately it is a game of finance. So it's about talking to the professionals. But yeah, on that note, I think with experienced buyers, it's a different story. They're actually seeing opportunities, aren't they? And especially the ones that we're working with, that have got the 3, 4, 5 properties, they're actually coming into the game now because they've played the game. They've been through these sort of cycles. They know what happens on the other side of it. And so that's reality. And I don't think that will change ever. And that's where the wealth gap really starts to increase even more than what it is now.
Yeah, and you totally nail it, because that's exactly what's happening. Experienced investors, they'll ask, "What's the opportunity?" Where the first time investors, the ones that are scared, will go, "What's the risk?" So, and none of these questions are wrong. It's just that they lead to very different conversations, very different thinking, very different action afterwards. And I think that, but also, even I've seen that change with myself. Now I'll be gearing myself and putting myself in a position, particularly as a business owner, and knowing the rules. What can I do so I buy in the next 6 months? Because I think I see the next year is that the biggest opportunity to buy property, because the markets will be shaken. And
100%.
it will be great buying. So, um,
GFC, best opportunity. Then it was the APRA changes. Then it was COVID. And what happened after every single one of those, those huge economic impacts? And the fundamental thing is that we've got a housing shortage. If we had a million homes where we had only 200,000 to find for, happy days. Wait, because property won't go up. But it will, because we've got a housing shortage. It's supply and demand. It's normal, isn't it? And I think you're right. I think personally, I'm also, um, you know, going on a little bit of a spending spree, to be honest, over the next 6 months. I've been hitting you up for all these different structures and borrowing capacities. I'm keeping you busy. But yeah, personally, I can't wait for these type of opportunities, because whilst the people stay out of the game, I'm in the game, and I get the best deals. So, I think on that note, if you were starting again, Jasmine, I assume it's look, I should say we are sitting in a position where both of us have extensive property portfolios, right? If I was a new investor with I've saved for the last few years, and I'm like, oh, I've saved so hard, I don't want to blow it because I don't have security behind me. I do get it, and um, I suppose where we're coming from for those listeners is that we were there once too, and ultimately you've got to do something different if you want to get ahead of the normal population out there. And so if you want something to look forward to in retirement, you have to do something different. And it's these types of opportunities that really give you a head start, actually, which is funny to say. Yeah.
No, 100%. And for me, the advice that I will give is to really build the right advisory team
Yeah.
around yourself, to just, if you're buying a property, buy it by a buyer's agent that really can find the opportunities and properties that will grow. So when you leverage by using the bank's money to buy, that actually makes a difference, and there is growth, because I have seen and I have worked with clients who have bought properties on their own, and the properties have not done well. So you really need to focus on the fundamentals when you're buying and buy the right properties, but also have a good accountant on your side and a good financial planner potentially if you needed to. It just depends on what sort of stage or what you're comfortable using, but and definitely good mortgage broker that is
Absolutely. I think
investment
we've
savvy that can just make your dreams possible.
Yeah, I think we've touched on, yeah, and I completely agree with the accountant, buyer's agent, the broker. We touched on the broker because of all the different types of lenders and the different policies, but also ones that can forecast your future as well, not just look at your current borrowing capacity and pick the right lender, is looking at the overall strategy first and then reverse engineering it. We do that well, right? We talk to investors who have, million plus borrowing capacity, and we dial it down to, okay, this is what we think you should do, based on your borrowing capacity to get to the goals that you need to get to, not just focus on the current borrowing capacity. So I think that's really important, and it's also important to work with a buyer's agent or financial planner or accountant that can also do that as well, to look at your forward forecast, not just your current situation, which is really important. So you touched on what you're planning to do over the next 6 months, but hypothetically, if you were starting with no portfolio, would you still invest in property today, Jasmine?
Most definitely. You're talking to the converted.
Yeah, yeah, it's no brainer.
I mean, most definitely. Just use the bank's money as leverage to help you, but buy well. Because I think that's also part of the problem that a lot of people have not bought or haven't made the right investment, have invested in a wrong property, wrong asset, and then they've had issues. So, but if you do have the right team behind you, and if you use the fundamentals for buying a property, because just simply because of the Australian population and the growth and the chronic undersupply, and this current government is really not helping with that either. I would definitely not wait. And as I said, I will be going ahead, and the next 6 months will be I'll be going on a bit of a shopping spree. Will be interesting, be fun. Yeah.
Absolutely. No, I think it's just funny how it works. So, fast forward 10 years, what do on that note, in 10 years time, looking back, investors will more than likely regret not buying at this time, because 10 years time is a completely different story, and that's why we invest. Um, would you agree?
Yeah, 100%. And look, I learned this lesson personally. I've always was a risk taker, and I had already, few investment properties anyway before COVID hit. But COVID was a different beast. Like, it really scared me. But I learned my lesson then that I shouldn't have been scared. And if I only bought a property or properties then, I would have been 10 times better off. So now I just, for every crisis, I apply the same rules. If there are, if the principles, if I've got all the risk mitigation strategy behind me, I've got a buffer. If I've bought a good asset, always invest, and don't you know sit on the sort of boundaries and watch what's happening, because as long as you're watching and you're not in the game, I think you're missing out.
Absolutely. I think the greatest investors buy when there's opportunities and sell when it's an absolute hot frenzy. Whereas the general population sit out when there are opportunities, and sell when they don't have to. Because yeah, and that's really the difference between the good and the average one. So I think that really covers the budget, obviously finance and strategy as well, Jasmine. So, um, as always, it's a pleasure to talk to you. And, we're, like I said, we're talking to clients all the time, about all of this as well. So, if anyone out there who is looking to, get finance, talking to your bank, please stop and talk to Jasmine, or any other good broker, and really understand your situation. Plan. You don't have to take action; just get the planning going, because it takes time to buy property as well. And so, you want to make sure you do it right. So, Jasmine, thanks so much for coming on today. It's always a pleasure, like I said, and I really look forward to chatting with you again on the podcast.
Thank you, Anka. It was absolute pleasure for myself as well. Thank you so much.
No
Big sir.
worries. No problem. Well, it was a different one for you guys today, and thanks so much for joining in. And yeah, if you've got any questions, reach out to myself or Jasmine online on socials, and would love to have a chat. Thanks, guys. Hey guys, thanks for tuning in. If you enjoyed the chat, feel free to drop us a rating on Spotify or wherever you listen. It helps us reach more listeners to help them with their journey. Catch you in the next episode.